After that, you've got those things in place, changes are being made. What's the next component?
Well, step 4 is really looking at the exit options. So who are the likely buyers and how will they look at the business? It does tie into the sort of the value enhancement quite a bit, because different buyers look at will have different factors. But so we'll look at, is the business, right now the biggest change that's happened in the market over the last 10 years has been the rise of private equity. So, private investors pooling their money to buy private cash flow businesses. Typically, they hold on to those businesses for 5 to 7 years, and then look to sell them at that point to return their investment to the investors. But that's been the biggest change. So, if the company is going to be attractive to private equity buyers, then that sets us on a particular sort of course of action, not only in terms of the value enhancement, but in terms of sort of preparing that business.
And what kind of business would be attractive to that market?
Typically, when private equity really started, they were looking for larger businesses, I'd say $3 to $5 million of earnings and up. They wanted strong management teams. They particularly like to partner with management. So most private equity companies would rather own 70 or 80% of a business partnering with management than to own 100%. They want sort of management and themselves to be aligned in terms of objectives. So they like big businesses with lots of cash flow and that have a growth potential. Private equity companies, one thing they have is cash. There are, depending upon which estimate, I think the latest one I saw is well over $1 trillion of what they call dry powder in the private equity market. So that's money that's been committed by investors that has yet to be deployed in buying businesses. So they have lots of money. So they don't mind writing check number 2 and check number 3. So if they can buy a business and then spend more money to buy add-ons to that business, or to invest in growth or new products or geographical expansion, they like to do that. So we'll look to see, is it a business that private equity will be interested in? Are there strategic buyers? Are there buyers within the industry that will see some kind of synergy in buying that business? One thing that's become really interesting over the past 5 years is that a lot of private equity buyers are becoming strategic buyers.
How so?
So what they'll do is they'll buy their initial platform investment. So let's say that a private equity company invests in an industrial service business that's, $3 million in profit and has great growth potential. Well, now within that platform, they'll look to do add-on acquisitions. So that will be synergistic to that original platform business. So you've got a synergistic strategic buyer who has synergies that they want to take advantage of, who are backed by private equity money. So you've got a company that sees synergies and who has lots of cash and are very aggressive and professional acquirers. Right. So it's a great opportunity for someone selling their business if they can take advantage of those 2 factors. I'll give you an example. We have a client who's a window manufacturing company, and they would be very attractive to the company that supplies them with the materials they use to make their windows. So that manufacturer might be looking to buy that window manufacturer as an offensive reason. But it would be terrible for them if their competitor bought that company, because they would also lose the supply business to that competitor. So they have a defensive reason as well. So that's a great opportunity for
that's
a vendor.
Good for the seller, absolutely.
Exactly. Yeah, and that's who we work for. So we look for those opportunities. Yeah. There's entrepreneurial buyers, which is something that's expanded greatly in the last 2 or 3 years. So that's people who have access to money. They have at least the perception that they can run a business, right. And they want to buy a business to run it. So they basically want to tag in for the business owner who's tagging out. So they often come from consulting, the accounting business, banking industry, private equity. they've kind of watched businesses run from the outside, and now they're ready to be on the inside. So, you know, they want to buy a business and they want to operate it. The last group, I guess there's two more groups. One would be management. We see more and more management buyouts, and what they're being encouraged by the fact that the banking community seems to love to lend into management buyouts. There's a lot less risk for the bank when the buyers of the company are management itself, who already understand the industry.
there's continuity.
There's no sort of, there's continuity. There's no sort of transition loss in or transition gap. So management are becoming more and more interested. It's there's some interesting opportunities there, you know, to sort of phase in that transition. And the other one is within the family. It used to be, you know, I'm an old guy. In my generation and older generations, it was pretty common for kids to take over the family business. You'd have second and third generation businesses. We see now that it's a lot less likely. Fewer and fewer kids want to take over the family business.